Hello, everyone. Welcome to the Raise Capital Legally podcast and YouTube channel, where we talk about topics of interest to real estate syndicators and fund managers, with an opportunity for live questions and answers before we sign off. I'm Krisha Young, co-host and business development director for the firm, and this is securities attorney Mola Bosland. Now, before we get started, please note that audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. You can ask questions at the end of the broadcast by raising your hand or typing it in the Q&A. Information discussed during this event is of a general educational nature and should not be construed as legal advice. So now today, our topic is how to protect yourself when investing passively in a syndicate. So please join our host, attorney Mola Bosland, as she interviews Syndication Attorneys' longtime clients, Jake Stenziano and Gino Barbaro, about their new educational course, Passive Investing Pro. They've created this course to help passive investors learn how to protect themselves and their hard-earned investment dollars when evaluating group real estate investment opportunities. Jake and Gino will share with the audience, with you, what their passive investing course entails and how it can help align interests between passive and active investors in syndicated real estate projects. You are in for a treat. Welcome, everyone. Hello.
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 How to say you're not an attorney, right? Without saying you're not an attorney. That was a very professionable and felt very legal. And Gino, just remember, the title is How to Raise Money Legally Today. Okay, that's what they're calling this. So just keep it between the lines, all right?
I will do that.
As opposed to illegally, right?
Right. So. That's right. That's how that works.
I got it.
Hi, guys.
So we're talking about raising legal money today.
Yes, and how you guys are going to teach people to do that with your new program.
Well, actually, let's start talking about what mistakes people have made. And I think the biggest mistake over the last market cycle is someone has a podcast or they wrote a book, and all of a sudden they become a thought leader. And it's like, okay, that person has a show. Jake and Gino's got 6 million downloads. Let me go invest with that person. And I think we've seen a lot of that. And people say know, like, and trust. I think you'd have to know, like, and trust the person that is, bringing you the deal. But I think you have to take it a few steps further than that. And I think that's Mola, and that's one of the biggest mistakes that I've seen over the past 4 or 5 years. Now, if you want us to jump into this framework that we've created, I think it's important for people.
Hang 1 second there, Gino, because I think you basically, quoted Ronald Reagan: "Trust but verify." It's wonderful to know, like, and trust somebody. And there is a Ronald Reagan movie coming out, so I think that was a very appropriate time. Dennis Quaid, something like that. So
yeah.
Anyways, think about that for a second, because we've spoken to folks who have invested in deals that, and not to be rude or whatever, but like the avatar that you're basically describing, listened to podcasts, read books, created rapport that way, and then invested money with folks because they feel like they know, like, and trust them. But then the trust is built, but did they verify the deal? And that really encompasses the whole premise behind Passive Investor Pro, because just because you're placing an investment passively, you still have due diligence work. You still have responsibility there to place your money appropriately as the general, right? We joke a lot about baby money soldiers, and the whole idea behind that is you're the general of your money army, and you want to place the dollars to take over. Think of the game Risk, right? You're going, taking over properties, pulling money out, for reserves, going and taking over the next one. You have responsibility there, and just because you're placing money with someone doesn't mean, well, it's easy, put the money in and I'm out and I don't have to do anything. I think there's a lot of vetting on the front end that should take place in order to make sure you're not lighting your money on fire.
Mm-hmm. Yeah.
And that's definitely true. And I think where that people fall off is they don't verify or look into that person's actual track record, right?
Mm.
I can go out there tomorrow and be like, I'm a syndication attorney and I've co-written this book and I have this podcast and you guys should just invest with me. Well, that's nice. Yes, I've done these things, but what have I done to show you that I know how to manage other people's money, right?
Mm-hmm.
What is my actual track record for my prior investors? And I think that's one thing that we do talk to our clients a lot about is that track record is extremely important because it is a foundation of trust that you got to build with your investors. But if you can't prove to them how well you manage other people's money, why would anybody want to invest with you or keep investing with you?
I agree. And Mola, what we can do is we can jump into this framework real quick. But the reason why Jake and I created this framework, especially myself, I was a passive investor back in 06, previous market cycle. This was life before Jake. And I made all the same mistakes that passive investors are making today. And I was pissed off. I was mad at the person who I invested with. But ultimately, I had to wake up and understand it was my responsibility. I was the one who made the mistake. I was the one who stroked the check. And I think that's what passive investors have to understand right now. If a deal is going bad, you have to take it upon yourself. You're responsible. You're the one who wrote the check. I mean, obviously, the general partners out there are not doing a great job, some of them, but you're still the one who invested in the deal. And how do you go about start looking at these deals? So we created this 3-step framework. We call it, the sponsor, the alignment of interests, and the deal. So if you can just picture the sponsor, he's a jockey, he's got that little hat on. Then you have the alignment of interests, which is what we call the saddle. You're sitting on the saddle. And the third one is the deal, is the horse itself. What most passive investors doing correctly is they always say to themselves, I got money. I need to find a deal. Where's the deal? And that's exactly what I did in my first investment. Instead of looking first at a Mola or at a Jake and Gino who is running the deal, the sponsor itself, they're looking at the deal first and doing everything backwards. Now, Jake and I, we don't syndicate deals. We are actively pursuing our own deals. So we're looking at the deal. That's what an active investor does. We're looking at deals, we're looking at markets. But if you are a passive investor, you need to understand how to vet a sponsor. And it's not just experience. That's important. There are other factors to it. But more importantly, after that, let's talk about what the passive investor is trying to accomplish. Are her interests align with the general partner's interests? That's really important because I think sometimes they get allured by that one number, that IRR. And that's not the all be all. There's so much more than that IRR. And ultimately,
how did they get to the IRR? That's where I think a lot of it stops. Is they take the underwriting outcomes, and many of the passive investors stop there. They'll look at them, but they'll not dig any deeper into maybe what's the median income of that area. What's the property management company? I think it's okay to dig a little deeper to vet these. To ensure that you're going to be okay. What's the current income? What are they promising? Are they saying 20% rent growth in perpetuity, right? And that's like a running joke now, but there was underwriting showing that, 2021, 2022, right? So there's some things where I think, the passive investors can do a little bit more due diligence on their end to vet these deals versus just stroking a check and praying.
There's a lot more. And that's something that I do talk to our clients about when they come in, right? And they always ask about building substantive relationships and things like that for their syndication. But I always emphasize you have to understand your investors' investment goals. Because if they don't align with yours, they're not a good fit for your deal. You don't just want to take their money because that relationship's not going to work. Someone's going to be very unhappy in the end because their goals were not realized or not met. And so you have to really consider what your investment goals are as the syndicator and what your investors' individual investment goals are, not just the fact that everybody wants to make money.
That's great. I love that. That's excellent advice.
Gino, you want to break down the different segments of the analogy? Yeah,
I would love to, but before I talk about the sponsor, I'm going to go with what Mola was just saying. And to me, it's mind-boggling, even now, in this part of the cycle where we have a lot of students that are raising capital, passive investors are not asking these questions. And the first question is, if you're investing passively, could you please ask what the fees are in the deal? Please understand, what's the acquisition fee? What is the co-promote? What's the preferred rate of return? What's the hold time? I am stunned by the fact that most passive investors don't ask that question. Ask what the fees are. And it's not a gotcha question. And then go online and see what other groups are charging to see if your group that you're investing with is in alignment. I'm not here to say a 5% acquisition fee is too much. If that's what the going rate is going in the market for that type of asset, then that seems fair.
You have to weigh it against the rest of the fees in the deal too, right? So maybe that's high, but something else is lower. Right.
Absolutely. And I think the other question is, when I made my mistake with my first syndication passive investment, is my general partner, the man who was running this deal, he had no skin in the game. So I had all the equity in the deal. He had none. And even worse was we were splitting payments. I should have been able to say to myself, let me get all of my capital back first, and then you receive some type of distribution of profits. That's something where our interests weren't aligned. And it's something where if you're looking at a deal, I'd like to see the sponsors have some skin in the game, because if that deal goes south, it goes bad, I want that sponsor to work really, really hard and, do everything he or she possibly can do before they have to walk away from the deal. And that's really important. And that's what happened to me on my first deal. The sponsor had no money. He had nothing. I mean, he walked away from the deal. He didn't lose anything. He lost some time. I lost all of my capital. So be prepared with that one. And I think the last one is not the last, but one of them is, if you're a passive investor, understand that there is risk. If you're seeing sponsors out there saying it's risk-free or guaranteed returns, I would just say not walk. I would say run from that. Run. And one last thing, if you have $25,000 to your name and that's all you have, and an investor, a sponsor comes to you and says, invest with me, all of your capital, I personally would not do that, because that money may be tied up for 3, 4, 5, 7 years. You don't want to risk any capital that you're not able to lose. So it's important that, if you're a sponsor, understanding that and maybe relaying that to the investor that you're speaking to will also make you a better sponsor, and will, I think, hold you in higher regard in this industry, because a lot of sponsors, they haven't been doing that the past few years.
I can really understand where you're coming from with that. One, with the not putting their own skin in the game. I have that conversation with people that come and say, oh, we have this deal, and where our contribution is our sweat equity. And I was like, but what are you putting into the deal? I go, let's be honest. And I always tell syndicators, look at it from this perspective. If someone came to you with the same deal and told you that they were not putting any money in, would you want to invest? I'm like, you have to think investors are going to look at it the same way you would have looked at it if it was a deal presented to you. So if it's something that you aren't going to accept, don't expect other people to accept that as well. So you should put money into the deal as well, because you're showing them that you're willing to put up something at risk just like them. Period.
I agree.
Yeah. So I think, so let's see. So tell us actually more about the actual program, because I like you guys' classes. I've been to one.
In Jacksonville. We jumped over the sponsor one. I think the sponsor one, like Jake and I said in the beginning, it's probably the most important if you're investing passively, because you want a sponsor who does have experience. But Mola, the experience can't just stop, hey, I've been in real estate for the last 5, 6, or 7 years, because they could have made money in the part of the market cycle where cap rates were compressing and they didn't have any NOI growth, and they just made money just because of the market itself. So understanding their business plan, what they've achieved, what they've accomplished, and what deals they have currently, I think it's important. Looking at them and saying, hey, they've gone through a couple of full cycle deals, returning capital to their investors. I like to look at a sponsor who has great communication, not only when things are going great, but when things are going bad. And maybe ask the sponsor, when have you lost money? And when you have lost money, how have you handled that? And if they haven't lost money, they haven't been in real estate that long. I'm going to tell you that right now. It's just important to understand those questions. And I think Jake had mentioned early on, when you're looking at a deal to invest passively, not only are you going to look at the sponsorship team, every single person who's a general partner on that team, but you need to be looking at their syndication attorney. You need to be looking at their CPA. You need to be looking at their property management company, which is super important. You need to be looking at their asset management. You need to be looking at every single one of their team members and vetting them for the experience and making sure that, hey, have they done the job? I mean, as far as property management, I would go so far as to say is, hey, pick up the phone, call the property management, secret shop that property management that they're utilizing. And one mistake that I made, this may be crazy for a lot of passive investors, but if I had gotten onto a plane and flown down to my first passive investment, I would not have invested in that deal. I would have seen the deal for what it was. I would have seen the market itself, and I would not have put money into that deal. Now, if you're saying that's just overkill, you're putting $50,000 or $100,000 of your hard-earned money that's taken you maybe years to accumulate. I think, a $300 plane ticket and a half a day off of work, it warrants it, especially if it's your first deal. Now, if you've done 5 or 6 or 7 and you feel comfortable with a sponsor, but if you're just starting out and doing this, I really would love to get my eyes on that property. I'd love to get a feel for the property.
That's where I'm at, Gino, is pressing the deal, actually, not just accepting underwriting outcomes.
Yes.
Dig in a little bit. It doesn't have to be a ton either. It can be, what's the vintage of the property? What's the median income? Okay. Look at the underwriting. Where are the current rents at? What are they claiming they can achieve? And are there comps to support that? And ultimately, the sponsor should have that information if you need it, right? And then you can vet what they're promoting, because that's really what it comes down to. There's not a ton here and it's not going to take you years to sift through this. We've been doing this long enough. I can tell a deal typically within a half an hour, right? If you send me over a deal, I can get online, I can look at it. I may get on site and something may change, but 95% of the time I have a pretty good idea if this is going to work or not. And so the more reps you get at underwriting and looking at these things, half hour to an hour, maybe a visit to the property to save 50 grand in a mistake. This is what we're advocating for. Yeah. And then also looking at the alignment here between the sponsor, between the relationship, what you're getting, what they're taking, et cetera, and then the actual deal. And that's the real culmination of what we're promoting.
And Mola, I think just one thing to add before we move on to this. If you're a passive investor and you're just starting out, I would ask, even if you don't understand the documents, I would ask the sponsor for their underwriting, and I would even ask for a T12 and a rent roll. And if they say no, it's proprietary, I would not feel comfortable investing that deal. I want to see how they've derived their numbers, because it's not proprietary. If you want my hard-earned money, I need to understand what this underwriting says, and maybe you could walk me through all of these, examples that you have down here, as far as like Jake was talking about, with rent growth, with the going in cap, with the exit cap. I want to understand all of that, and if you can't share that with me, then I'm telling you, I don't want to put my money into that deal.
And the price per door too. Like if you're buying a 70s vintage product, and you're not getting a steal on it, I'm going to be concerned with that plumbing going forward. And there better be a lot of room to be able to correct that. And so I think that's also something that LP should be looking at. Probably newer, more stable deals. I think there's less risk there. So. So Gino, I think what I'm trying to glean from this is you were going down a road where you're explaining, the jockey, the relationship and the deal. You want to kind of just hit each one in order so that we're kind of bringing this home for folks.
Yeah, sure. I was going to actually let you go through the deal, but if you're a passive investor and you're just starting out and you're just looking at real estate, I think the first thing that I would do is I would pick a niche in and of itself. We're here to tell you we love multifamily, but if you feel comfortable with RV parks or you look at mobile home parks, just choose one, especially if you're just starting out. That's the very first thing. Then the next thing is you need to start going online and looking at people who are actually in the multifamily space or in the RV park space. Start looking at sponsors and, connecting with, Mola's team and going on Cash Flow Portal and all of these other, investor portals. They all have deals placed on there. They all have people who are sponsoring deals and running deals. Find out those people. The first part is in understanding how to vet that kind of person. That's what we teach. The next part, which is pretty tricky for most investors, because when you first start out in investing, you don't really think of yourself, but your goals are what's important. I mean, you should really be thinking about what's in it for me when you invest. What am I trying to accomplish here? Am I trying to leave my job? Am I just trying to get some more retirement income? Am I trying to create some cash flow to pay some bills? Understand what your goals are. And more importantly, where's the capital coming from? Is it coming from retirement accounts? Is it coming from savings? Is it coming from whole life? How long can you have the money invested for? Understand all of that. And then the third part, which I'll let Jake hit up because I know he loves talking about the horse, it's the framework. framework, the buy right, the manage right, and the finance right. Once you've understood, you like the sponsor, you like the market that they're in, you like the investing niche that you've chosen, you understand what your goals are. Now, Jake, let's talk a little bit about how you start actually analyzing these deals using that 3-step framework of buy right, manage right, and finance right.
Yeah, I think, going back to the buy side of things, I would be looking very closely, as I alluded to the vintage of the property, something that is, probably 1980s or newer. I don't want the huge CapEx nightmares. And I think the closer you get to, 2000s, the better, because the sponsor doesn't have to be as good most of the time in order to make something like that work, because if the sponsor does not own and run a property management company, they're going to be relying on third party. And we'll get to that in a minute, but there's going to be more repairs needed. And the third party property management company will probably be charging fees, for these various things. And it can just start to eat at the yield. So that's one area that I would definitely look at. Median income is huge. I think if it's not 60,000 or more for the median income, I would be nervous. It just tends to ultimately lead to delinquency, payment issues, and higher crime. And so that's something that we've seen, and a mistake that we've made in the past. So I would definitely be looking at the median income very closely. And the deals that, if I were in an LP shoes, that I would be interested in, something where it's again a newer vintage, and it was maybe mismanaged from a market rate perspective. And what I mean by that is we saw a huge run up with inflation and rents over the last 4 years. The deals that I think really make sense, that are stable and that work well, probably the ownership group did not push rents enough. So there's a gap there from where the current rents are to where the market rent is. And something like that makes a lot of sense, because that's an easy sort of lift to get to, in the course of 18 to 24 months. So I'm not saying that, it's easy and everybody can do it, but it's a lot less skill. And so I think that your probability shoots up, right?
You're talking about operations, Jake, right? Just from everyone's understanding. Their operations aren't where they're supposed to be. Their expenses may be a little bit too high. Their income is a little bit too low.
I'm literally speaking about top line revenue. Yes. If to be very specific, and folks that did not keep up or keep up with what the market rate is doing. And look, this is easy stuff to figure out. So the current rent is 1,100 average rent, and you can look at the different unit types and pull comps even from apartments.com to verify what the sponsor's telling you. That doesn't take an incredibly long period of time to do that. And as long as they execute on a renewal plan, you should probably be okay there. Right. Mm-hmm. And so, looking at those different criteria, you could get a little bit more, in the weeds with the physical aspects. Like we prefer pitched roofs. Okay. Going back to the vintage, the 80s or newer tends to lead to better plumbing and such. We don't like massive wooden decks, though those tend to be either insurance claims because someone's going to get hurt. Upkeep is more challenging. So it's avoiding these costly expenses over time. It's just one thing that we're really big on just internally is the breezeways. If you're buying a garden style complex with breezeways and it has sheetrock in them, it's nearly impossible to keep it up at a high level, right? And so if there's already vinyl or some sort of siding in the breezeways, it's those sort of things that we ultimately end up looking for. So look, as an LP, you're buying the deal, you're buying a fraction of it. So you should care about these things. I think Gino's point earlier, getting on site, evaluating that. And then the management. So we look at buy rate, manage rate, and finance rate. When it comes down to the management, Gino suggested maybe secret shopping the management company. There's a few things here too. You may be getting with a group that has in-house property management. I'm not saying that that's a must to go with a vertically integrated group, but as ourselves, with vertical integration, I'm a firm believer in it, because you're ultimately going to pay more. It's not to say that a deal is not going to work by any means. A lot of people do third party. A lot of people, have a lot of success with it. I just think you're increasing your odds of success the more you can, remove additional fees that are going into the deal. And then from a financing perspective, this is a very interesting one, because I want to tie insurance into this as well. From an LP's perspective, is the sponsor going to agency out of the gates? And if they are, there's a lot of bumpers put in place there. There's a lot of requirements that the agencies are going to require on the front end from a debt service coverage ratio, from the loan to value. They're going to get on site and do an inspection. And if they see, a lot of trip hazards or, 30-inch railings that someone could fall over, whatever the case may be, they've done a lot of the work to insulate the investor because they want these returns to pay off. Also, the insurance companies. So, essentially, we've modeled our buying criteria, over the years and what we've learned from our insurance partners and also the agencies. So if you're going into a deal and it's going to be some sort of like bridge loan that's floating or, something else to get the deal financed, there's inherent risk in that itself. So as an LP, look at what the financing is, maybe understand or ask to see some of the inspection reports from insurance or the agency, because that's going to really tell, quite a bit. These companies have done the work to ensure that the deal is going to pay over time. Very few, Fannie Freddie deals go bad. Bridge debt and other types are the ones where the risk is. So that's another way to insulate yourself as an investor.
Jake, to wrap that all up, I would say, as an LP, once you've factored those first two, the sponsor and the alignment of interest, you need to start creating a buy right criteria. Like, what kind of assets do you see yourself buying? And we're not here to tell you to buy newer assets. You may like buying older assets in older neighborhoods. That's fine. Just go in eyes open, but understand what your criteria is with buy right. The manage right, I'll push back on Jake a little bit, because it's not the end all be all to be your own vertically integrated property management company, because there are people out there that have their own property management company and they're not really
vertically integrated company, right?
They're not great. They're not great either.
Yeah.
Yes. I'm just saying, because they may have just started investing in real estate 3 years ago and they just got a property management company. So I'm not saying that's the end all be all, but property management is where you make the money in this business. It's the customer service. You walk into a unit, that's the first person you see. So I would be calling them up, and I would even be looking at other properties that they manage. And that's really, really important. The operations is important. You're looking at the income, but also the expenses and where you can save. And then Jake said the finance right, understanding the financing component of this asset. So if you put buy right, manage right, finance right, you put all those together, you can start analyzing deals and what kind of deals that you're looking for.
And what I want to say is that as an investor, you should really ask to see the term sheet. There is nothing wrong to ask your syndicator for that term sheet, because you should see what types of terms they've gotten for that loan. And I can tell you, by not disclosing whether it was a bridge loan or something like that, can have a very negative effect. We have seen clients.
There's no way I would do a deal as an LP without understanding the debt. There's no way in hell.
So Mola, you've seen that? Have you seen that?
Yes.
Wow. Okay.
We've seen it where an investor found out afterwards that it was a bridge debt and was like, that's not what I signed up for, and I want my money back, and I want it back now.
But shouldn't that have come up in the exploration of like the business plan? Because when you present your business plan,
or was there some raising debt illegally going on there, Mola? Or some raising money illegally?
I don't know about all of that, but I don't think
well, we need you to know about all that. That's what we have you here for, right?
I don't think it was.
We are also a customer. I want you to know about all that.
Well, I know listen, I know what kind of deals you guys do, and I know what kind of financing you got. I deal with y'all all the time, so I already know. So this is a little different.
How can they get, like, when you're a passive investor, understanding the business plan, they must not have heard or paid attention, or they might have been ignorant to the fact.
Sounds a little shady there to me.
But if Jake and I are doing a deal and we're buying a 100-unit deal and we need to rehab these units and we're getting this great debt, and how are you getting the debt? The deal is not stabilized. So you can't go to Fannie and Freddie because it's 82% occupied. It's got to be 90% for 90 days. Understanding that as an LP, I just saved you $50,000 because you know that bridge debt is very expensive. You have a certain amount of time. There's something called a rate cap for insurance that if rates go up, you can actually cover it. And these are all words that you have to understand as a passive investor. And Jake didn't mention, in our financing framework, we like long-term fixed rate financing. We want to get something financed on the front end for at least 5 years. So we take that risk off the table. And I think if LPs hear that, they're like, oh, well, I want to invest in that kind of deal. So if you see a bridge debt deal, I'm not saying it's a bad deal. I'm just saying there's a lot more risk, especially with groups that have a lot less experience like they've had in the past few years, because they need to move. They need to get that NOI up. They need to get the DSC up so they can refinance out of that loan into something more stable. So understanding is really important.
And I really think what happened in that deal is maybe the investor did not truly understand the financing.
They learned about bridge debt after the deal closed, and they were like, I want out of this shit.
And when they found out that that I think there was a capital call done actually so that they can complete the renovations, so then that week they could refinance so they can get permanent debt. I think that's when it set red flags, and the person probably just learned all the real terms and was like,
that's why you got to educate yourself, though. That's exactly what we're trying to help folks with, because if you understand this stuff, you can vet the deals better. Syndicators are going to bring better deals to the market, and I think it's going to provide a better marketplace. And I want to be very clear. You can use bridge debt and make it work. Myself, as a general of my money, right? Going back to what we said earlier, I do not want to place funds in something like that, because I think it's more risk. And if I'm not running it and it's someone else is, I just have less confidence in someone else than myself in taking something like that down. That's just my perspective on it. And look, everyone's in a different place in life. That's my 2 cents.
Mola, that would be a good question to ask a general partner. In your previous deals, what type of debt have you used? And they should come up and say, well, we've used bridge debt, we've used Fannie and Freddie. And then the next question is, what type of debt are you using on this deal? So you get that right out of the gate. That question is answered, so you understand the financing, because the financing component is really, really important. Now, Jake, one more thing. I would also say, how much money are you raising extra to fund these CapEx deals? And if this money is being raised extra, are you giving it back to me as a form of cash flow to myself? Or are you giving the funds back? Or are you holding that back as CapEx? Understanding that you don't want to run out of money, and make sure that there's enough money in reserves so you don't get that capital call is really important.
Yep. You should understand that sources and uses that's in that PPM. You should really understand where that money in that breakdown is, because we get clients that are new to this. And when they provide us their sources and uses, we're like, this is not okay. This does not match. I'm like, you need to fix your numbers. I'm like, first of all, you need to have money here in the reserves. I'm like, people are not going to be comfortable if you say that your reserves are $50,000, but you're buying a $4 million property. That's not going to cover what's going to be needed eventually down the road for this property. Wow. So I'm like, you have to go back in here and you look at these numbers, because this is not doable. So,
and that's sort of why we created Passive Investor Pro, because we do have one-on-one coaching. I want a passive investor to learn the framework, but when you have a deal and you've got a deal that you need to underwrite, you bring it to one of the coaches that we have. They'll underwrite the deal for you. They're not going to tell you it's a good or a bad deal. What their objective is to say, your DSCR here is 1.18. I mean, is that a deal right there? They're going to look at the rent growth. They're going to look at the sources and uses and say, wow, they've only raised.
They're going to challenge you to say, does this have bridge debt on it?
They're going to poke all the holes in the deal. Right? They're going to try to, our goal at Jake and Gino is to teach people not to buy real estate. And that sounds crazy, because anybody can go out and buy real estate. We're trying to teach people not to buy it and not to get into these bad deals. So when you do find a good deal, it's like, wow, did I make a mistake here? And that's what ends up happening. It's like, I finally found a good deal. So understanding all of those pitfalls and poking holes in the deals is what the program and what Jake and Gino, the community, is all about. If you can look at these deals and see where there's weaknesses, you just show the person where there's weaknesses, then obviously, hey, if it's bridge debt and you think that the sponsorship group has done bridge debt before and they've got great returns, great projections, and you like their timeline and you like their underwriting, then by all means, you should invest in that deal.
Yeah. And I was just going to say, I may sound like a hater right now. I'm just speaking from my perspective and where I would and would not place my capital.
You're not a hater, Jake. You're a lover, brother. I got you.
It sounds like smart business. And, if you're a sponsor listening to this, then, pay attention. right? Like here's all what to do, what not to do, all of that. This is such a fascinating discussion so far. Thank you, everybody. I'm just going to interrupt real quickly here just to talk about the two books that the founder of our firm, Kim Lisa Taylor, she wrote.
What is she off in like the, you know, the
She's
hills?
The
hiking.
John Muir
She's up the John Muir
Trail.
Trail.
Hiking her
What a hippie.
210 miles.
I'm gonna run into my brother out there.
I think she's halfway now. Yeah.
Does she have a satellite phone? You know she's still alive, or did a bear get her?
Yeah. We've heard from her. She's all
We
good.
heard from her,
We had a
we
track
heard from her
record.
yesterday, or yesterday, the day before. So we know she's out there.
Yeah. Anyhow, we at Syndication Attorneys, we have two books and a ton of educational material on our website. But or we've got these two books right here to help you raise capital legally, raise private money legally. And one's for beginners and one is for more advanced capital raisers. And if you would like us to mail you a free copy, just text the word syndicate, SYNDICATE, to our phone number, 844-796-3428. Again, that's the word syndicate to 844-796-3428, or you can head on over to our website, syndicationattorneys.com. And there's a button on there where you can grab our book and check out other podcast episodes and our resources as well.
There's a wealth of information on the website, everybody. Seriously, you go to syndicationattorneys.com. Kim has written dozens of articles. I mean, the information there, before you even get the book, you could find 30 to, I mean, there's so many articles on that website. If you really have no clue, you should actually start the education there. And she did about 7 or 8 videos with us on Passive Investor Pro about building your team for, when you're investing passively. I think a syndication attorney is one of the components, one of the core team members that you need when you're investing passively.
Thank you.
And in the first book, right, that Kim wrote, the last chapter is actually dedicated to passive investing. It actually has a whole set of questions that you, as a potential passive investor, should be asking a syndicator before you invest in their deal. So it is, a very good tool to have, not just as the syndicator, but also as a passive investor. As a syndicator, it should give you an idea of some of the things that investors are looking to know. And you should be able to answer those questions as soon as they are asked to you. So,
Krisha, you made a great point, and we should have probably started the podcast off by saying it. If you are a sponsor, you should be listening to this, and maybe you should be tailoring your pitch to it. So get the book that Mola just talked about, those questions. You should have an answer to every single one of those questions and be transparent. And if you do that as a sponsor, you will have no problems in raising money. If you can make your presentation, your opportunity different, if you're able to answer the questions, if you're able to align yourself, if you're able to offer a great opportunity, you're going to have no problems raising money for your deal legally.
Legally.
Yep. That's the key.
Legally. All right, where are we at in terms of talking about the course and questions here, Mola?
Let's see. I mean, well, we've just been having such a wonderful conversation. The questions are there, but I don't know I like talking to Jake and Gino. I talk to them whenever I see them in person, and the conversation just always flows so naturally. So this is a lot better than a Q&A in my perspective, right? So we are all just giving our own 2 cents on, how your program works. But for those that want to know a little bit more, how about you give them a little bit more detail on, how it works with working with, mentors and people of that nature to help them understand the deals that they are actually interested in investing in.
When I started investing back in 2009, the first thing I did was, after losing tons of money, I joined a couple of mentorship groups, and it really helped me out. And then when I met Jake, I sort of knew what I was doing. I think I taught him everything.
I joined the Gino mentorship group at that point. I was the first student. Full transparency.
And you should have seen that. You should have seen
I was a sales guy and a really aggressive person turned humble pie real estate investor because of Gino's skills. That's true.
And it's actually interesting. On our third deal, he'd be calling me. He's saying, "Gino, we need this doc. document. We need this. And I'm like talking to my coach and I'm like, okay. And he's like, bro, you're a genius. Where are you getting all this stuff from? After we closed the deal, I said, Jake, I had a coach. I had a mentor.
Gino holds back till you get to know him. That's the truth. Like he's feeding me like schedule of real estate owned, PFS statements and things like that. And I'm like,
You
where's
like
this
that
coming
takeover
from? Like,
letters. I had all the underwriting docs.
I got an MBA and Gino had all the resources. So it was like I wasted my time until I found the GDED.
And I love that, Mola, how it really, I mean, honestly, it revolutionized me. It taught me how we created a framework. In 2016, Jake and I decided to write the book. And since then, I mean, we started the Jake and Gino community back in 2016, just focusing strictly on multifamily and building out the framework and getting on weekly podcasts. And it's interesting because you start a community thinking you're there to make a ton of money in education. But I mean, it's so amazing that it's helped our business so much with all the different vendors and all the different sponsors that we've had that we've been able to work with. And we've grown that aspect of it. But the education has grown into having a coaching program, having in-person events with our students, having a platform of over 1,000 students in the community that are doing deals. I mean, the students have closed over 80,000 units. They've raised over $500 million in capital, and they've closed over $5 billion in real estate. I mean, they've done some amazing things. And it's not just Jake and myself doing it. It really comes down to the community. And I think the last thing I'd say about this is multifamily, you know this probably better than anybody else. It's a team sport. You need to have, that network. You need to have the community, the accountability. You need to have the person to go for when you need a syndication attorney or a 1031 specialist or a cost segregation specialist or an entity specialist, whatever that looks like. You're starting out. You don't have those resources. We have those resources in the community.
Yeah, I'll just add to that. Ultimately, we were first and foremost a real estate company. We've invested in over 2,000 units. We hold most of our deals. We hardly ever sell. We don't syndicate. We don't raise money from anyone else other than our team. So we have over 80 team members on our property management. We allow them to invest in our deals. They are technically syndications, but we don't raise money from the Jake and Gino community because we feel like it's a conflict of interest to be raising money from our students. We don't have a community so we can go and raise money from people. We have a very sound real estate business, nearly 400 million in assets under management. We're not looking to take money from folks. We like investing and holding our deals long term. So the community is strictly results-based education for the people coming in that want to learn how to invest and buy real estate. And then with all this stuff that happened with the run up from 2021 to 2022, we added Passive Investor Pro to our platform for people that want to invest passively. Maybe you're a doctor and you love your job, but you want to get into these deals. We wanted to be able to educate these folks to invest in deals that follow a framework that we believe in, because we definitely saw some over-levered floating rate debt deals that I think if LPs would have known more, they would have not put their hard money into. Exactly. Yes. And so that's all we're trying to do, really. At the end of the day, the education company, the Jake and Gino community, it's results-based education. As Gino said, over 80,000 units closed. That's the primary driver. If we're helping people place capital in the deals that make sense, we're doing what we're supposed to be doing. And then in the day-to-day, we're focusing on our investments and sharpening our sword and making sure that, we're staying ahead of the curve. And this has been the best learning experience for me, ultimately, the Jake and Gino community, because there's been so many things that we've learned from other people and vendors, to Gino's point, that have enabled us to scale our business. And then we're able to share it with our folks. So, as I was joking with Gino the other day, as I get older, I get more closed off, right? And I tend to not want to network, and I hide in my little house here from the world. But this forces me, things like this, to get out and actually speak to folks instead of being like a hobbit hermit, hiding out. So thank you guys for getting me out of my comfort zone, right?
Well, that's a good thing. But I love you guys' community, right? Because I've worked with a lot of people that have come from, your classes. I've attended a class just so I could know, what you guys were teaching everybody. That was one of the things, Kim and I had talked about like early on, right? It was like, yes, I'm an attorney, but I should also know what people are actually learning out there, right? So that was how I ended up coming to your class. And that's why I met you guys in person for the first time some years ago. But I have worked with a few of your, people that are part of your community, and education is key. They are not lacking, when they come to, they have, basic legal questions, but when it comes down to what they're supposed to be doing and for their investors and also for themselves. They're very well educated. So their questions really are more based legally versus us having
Which
to
they
really
should
walk.
be, right? We're far from legal experts and don't claim to be, but we do have the vendors within our community, such as yourself, that we share, you know, with the different community members. Because look, it's a team sport at the end of the day, and you know, we have, you know, I don't even know how many different vendors, from, if you go from the property management through the buying, the you know, multiple different attorneys that we use, whether it's title, yourself, contracts, LLCs, closing, trusts. I mean, this is really a team sport, and that's just on the legal end of it. So
Right.
you really need to build out your network, and then you can start to fine tune. That's one of the greatest things about the community is we've vetted a lot of these folks. You don't have to use them, but at least it gives you a place to start, right? It's a little bit of an Angie's List that way. So, which is pretty cool, you know?
And Mola,
that's-
you'd mentioned something important. I mean, it's all unique. I think everybody needs to understand their situation, and they need to talk to an attorney when they're doing a syndication, because structuring is different. I mean, ownership is different, goals are different. So it's important that you don't go out there and you rubber stamp it and get something online, something that's boilerplate, and try to spend a few $100 to save money. This is something where you need to get on a 2-hour call before you do a deal, especially if it's your first deal. Don't wait to sign a deal and get a deal in the contract and then give Mola a call. Start that process 6 months before. Understand these types of ways you're going to hold these assets, the LLCs that you're going to form, the structures, the partnership, the way to do it legally. It takes a little bit of time to get going. Don't wait till you have a deal in the contract.
Thank you. I see this all the time in my business development calls that I'm on with people.
Oh yeah.
You know, with like this ambition, and it's like, okay, that's great. I love that you want to do this, but there's some pre-work here that needs to be done.
Well, the great thing is, though, once you get the team in place, whether it's your third, fourth deal, most of that team, whether it's the surveyor, the title company, syndication attorneys, you know, closing attorney, whatever, if you're getting good folks on the front end, the team is going to be similar. So it's more like pressing a button by the third or fourth deal, and everyone sort of knows what they're supposed to do. And you're sort of in the background, just making sure things are getting pulled through. So it's, you know, once you get a few reps in, the process becomes a lot smoother.
Yep. And I've told that to our clients all the time. I'm like, the first one is always going to be your hardest, right? Because that's where you're trying to learn. You're learning where all the pieces flow. This is your first time, if you have a partner, really knowing how your relationship's going to work with the partner as well, right? So everything is going to just be day by day, and you're going to see how it goes. But the more of these you do, it gets a little bit easier and a little bit easier.
It's a lot easier.
You've made those steps. You know, I use you guys as an example all the time, you know, when people talk about management teams and putting together their own management teams. And I'm like, you have to have a team that balances you out. I was like, you know, look at Jake and Gino. I'm like, Jake was the boots on the ground guy, and Gino was the, you know, behind the scenes person. And
Gino was the brains. Let's be honest.
Yeah.
Not really. If I was the brains, bro, we're in trouble.
I was like, but the way that you guys have made those roles work and meld so well together, that was putting together a true partnership. And look at what's grown from that, right? Besides doing your business.
And now we're just figureheads, and we have, you know, smarter people than us that are actually running that, right? Which is beautiful. So.
Right. But, you know, you started somewhere.
Right.
And so I use you guys as an example all the time about like the different types of roles that people can have just in the management alone. So.
Something, Mola, that can help your listeners out, and I think even you, when you're seeing people partner up, Jake and I call it values-based decision-making. Don't partner up with somebody just because it's a good deal. I mean, Jake and I work really well. We've known each other for 15 years. I speak to the guy 3 to 4 times a day. I like to hang out with him. I go to Knoxville. He kicks my ass when we play video games. It's okay. You know,
I have NBA Jam Arcade at my condo.
He
when
destroys
I bring Gino
me.
down, and I
can't play.
beat the crap out of him.
He's a good
sport about it. No,
I have no shot. And then he takes me for a 6-hour walk through Knoxville in 95-degree weather, and I'm almost having a heart attack afterwards. But I love him. But really what it comes down to is it's values-based decision-making. We had the same values. I mean, we had the same ethics, the same moral, the integrity, the family, the long-term.
Gino sweat in the elevator after the 6-hour walk.
Yeah, you like that, huh, brother? You thought I was making I almost died that day. I'm like, dude, he goes, let's go for a walk. So you think a walk is like, you know, half an hour, an hour. And all of a sudden we're like, I'm like, dude, where's the condo? I don't even see it anymore. Where are we? And he's like, it's okay. It's over the hill. I'm like, you're killing me. I had long jeans on. And I'm a Floridian. I love hot weather. That day, I almost had a stroke when I got home, but it was okay. Love him.
Well, first of all, in Florida, we don't walk very far anywhere because it's too hot for that. So we already know those things. We know those things. We can't take advantage of him for that.
We
You can't
do.
do
You know,
that.
Instagram told me it was like good for your blood sugar levels to go for a brisk walk after a meal. And so I was like, you know, I want to make sure that, you know, Gino's not getting like insulin resistant here or something. So we're taking care of him.
That being said, it's values-based decision making. I see you, Chris, you're nodding because it's important. A deal is great. Maybe if it's a one-off, but if you're going to do a few deals with somebody, get to know them. And I mean, we joke around, but I know Jake, he's not going to quit. He's going to work as hard as he possibly can to
We're going to finish the walk.
through. And that's right. And you know what? I finished the walk with you, brother. Did I not? I mean, I almost passed out, but I finished it. And that's what you're looking for in a partner, to actually finish with you and not to let you down. And if you can find somebody like that, then that's the partner you partner up with.
In life and business, for sure.
Yes.
Yeah.
Right.
Absolutely.
I love the values discussion. It's like first and foremost, you know, what we should be like really honing into in ourselves is what are our values, right? So any kind of work you can do on that yourself to figure out what your values actually are, and then find that alignment. And you can have like values for like the sponsor group, like the business itself, values for your own personal life, you know what I mean? So, and then like wherever they intertwine, it can really help you build a strong management team. We surprisingly don't have any questions. Usually we have tons of questions, and
we answered it all.
We answered it all. Yeah, you guys are so awesome. So we've got 7 minutes left, and you know, is there anything that hasn't been said that you guys want to make sure that you bring to the table here? Also, we want to make sure that we are pointing people in the right direction, how they can find out about this course, and where they can go to learn more as well.
I mean, I'll wrap it up by saying that my personal opinion, I think now is the time to get into real estate. This feels like 2010, 2011 to me. We just saw a jobs report that came out that they overestimated jobs by 800,000. I say we've been in a recession for the last year and a half. That's when you want to get into real estate. When everyone's exiting and you're saying there's no deals, there's a lot of fear out there. This is the time to start getting into their business. Even as a passive investor, because there's going to be opportunities out there, understanding, getting the education, learning who the sponsorship groups are. And if you're doing this actively, now's the time to start networking with real estate brokers, because they're calling you back because they don't have the deal flow. They need the activity. So it's important that now, if you're thinking long term, you're going to have some opportunities in these next 12 to 24 months. So just shut the noise out, because whatever they're reporting anyway, it's not. To me, it's not true anyway, because now all of a sudden 1 million jobs, they overestimate. I don't know how you can overestimate 1 million jobs. It's just not. They were just hiding the information. So for me, if you're going to be looking at something to do long-term, real estate, if you're looking back and saying, I wish I had done it 5 years ago, look 5 years into the future. If it's 2029 and you're saying to yourself, I wish I had done it 5 years ago, you're here right now. Now, to me, is the time to get into real estate and plan for your future.
And Jake, I'll piggyback off that, because it's great to hear Gino say that. Okay, Gino, this is the time to get in real estate, but follow the money. Where is Gino putting his money? And the cool thing is, we have these two ladies here that can back this up. We closed a deal on August 1st. We're closing a deal on August 30th, and we have another deal set to close October 1st. So that's 3 deals over 90 days. He's not blowing smoke up your ass. He's putting his money where his mouth is. So this is a really interesting time, because the pricing makes sense if you know how to finance your deals right. I think the theme for today is finish the walk. You two ladies have been a delight. Okay, so I thank you so much. And if you're going to give me 5 minutes back to my day, I will go eat real quick before my 1 o'clock, and I'll take that shamelessly. JakeandGino.com. Check up Gino for Passive Investor Pro. He's a sweetheart. He'll send you a free book. I guarantee it if you just email him, Gino@JakeandGino.com. And I'm going to go get my.
I got their books. Their books are good too. I have those.
Jake, I saw you got 3 thumbs up in this podcast. Why don't you know? You got 3. I got 0.
If I do it like this, it's not coming though.
It's okay.
Winner, chicken dinner, my friend. You are the winner for today.
I'm in the Matrix, baby. What can I say?
Thank you. Thank you, Jake and Gino, and Mola as well, for being here. So what was the website again? JakeandGino.com?
I think it's Jake and andgino.com. jakeandgino.com.
Okay, not
A-N-D.
Okay,
That's
and
right.
Gino.com. Thank you. And for us, it's syndicationattorneys.com as well. You can check out our articles and everything there as well. Thank you. What a fun
Thanks,
pleasure.
ladies. Jake, I'm going for a walk. I'll see you guys later. Okay.
All right.
We're all gonna go for a walk now.
Correct that blood glucose.
It's not
You're
raining
good,
right
man.
now, so it's not raining, so
Yeah,
you'll be okay. Yesterday at this time it was pouring, and you know.
Have a
Bye,
great day.
guys.
All
Thank
right,
you.
thanks so much. Bye.
Bye.